get started with is an Excel spreadsheet here. Now, of course, for those of you that know, when it comes to Excel, Jacob is our expert here. This is absolutely his work here. I don't want to take his credit. He created this, and I can't speak to it the way that he can, but at least I can kind of explain this enough so you can at least set the proper expectation. Now, trading it with a small balance account doesn't mean that, well, you don't have that much money to put to it. You could still have a fairly comfortable retirement. Maybe you have an investment account, possibly a managed account right now, and you just want to kind of dive into trading on your own. It's a good idea to start small. We don't want our mistakes that we more often make in the very beginning to really deprive us of some of this capital that we've possibly spent our entire life or our entire career accumulating. So whether you only have a small balance or maybe you're just setting aside a small balance, again, this is meant to be somewhat kind of broad for most folks. Now, this left side here in the kind of purplish shaded area, this is meant to maybe just help folks understand the kind of realistic amount of income that you could expect to achieve based on the size of your account, right? We don't want anyone quitting their day job and taking on day trading if they only have $1,000 in their account. It's the odds are stacked heavily against you. But let's say that the median household income is around $70,000. So we're going to base kind of someone who's possibly looking to generate from their account $70,000. Well, what does that translate to? About $5,900 per month or $294.93 a day. And for any of you that might have done the math very quickly here and you said, hey, 294 a day, well, 365 days a year, that's actually over 100,000. Well, understand that, right? This is going to be based on the amount of trading days that exist, which can be anywhere from around 250, 255 is generally used as the amount of trading days. So this is the daily income for market days. And down below, we have the required rate of return to achieve this roughly $300 a day. And for a $1,000 account, you're going to have to achieve 30% on your trades a day, right? When the average stock market return is anywhere from around 7 to 10%, depending on whether you're looking over the past few decades or possibly even further. 30% in one day is right, unrealistic. Maybe you can do it once, maybe you can do it twice, but to continue that isn't necessarily something that we can rely on. Now, as your balance grows, the kind of rate of return that you need gets significantly easier, right? It feels like an exponential rate, right? It's not linear. When you double it here, you're already seeing 29 to 14%. So it feels kind of fantastic where, hey, you go from 1,000 to 5,000, you go from 30% now to around 6%. As you can see, it gets easier and easier the more money that you have. Getting to around this $25,000 mark, well, 1.18%, it's much easier, still very difficult, right? 1% a day. If experts, if institutions could generate 1% in a day, or everyone would be putting their money with them, that still would be a fantastic return, not just once, right? This is consistently, this is every single day, 250 times you're getting this 1%. And that's with the expectation that you don't get anything wrong. Now, of course, if you had $1 million, maybe now it gets a little bit easier, but still, right? 3 basis points in a single day, every single day is still going to be somewhat it's still going to be difficult to achieve. So the reason why we put this kind of daily return monthly, or if you like to look at it in annualized, right, 7,000% annually, it's just not realistic. So make sure that if you are going to be trading with a smaller balance account, whether that's 25,000, 50,000, understand that don't quit your day job for it. View this as ideally some supplemental income that you can make maybe on the side here, especially for those of you that are retired and use this as a bit of a hobby. I've seen some clients say they like following the stock market and trading because it keeps their brain sharp, and I can absolutely see the benefit of that as long as it's not kind of detracting from your overall kind of financial situation. So again, another reason, even if you have other investments and you want to trade, start smaller. So there's a few other parts here, and I'll go through these just a little bit faster. But over in this green section, this again is kind of adding that average stock return monthly and a daily rate, and talks about the market risk multiple. So the odds are kind of that you're going to be realizing a loss. And as we can see, it gets higher and higher and higher the 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 smaller the balance is. So this is just reminding you, well, the deck is stacked against you even more so the smaller the account is. And then finally, again, just to go through these last two a little bit faster here, this is kind of assuming that you start trading on kind of one of the worst days of the year, one of the kind of worst market scenarios, right? Where we can see the worst stock market, kind of year return, worst month. Now we're just looking going back, not through all the history, but just the kind of close near term history here, going back only a few decades. If you were looking at some worse returns or worse singular days, how difficult would it then be to recover? And you can see that adds it even more difficult, as opposed to when you're looking at the kind of $1 million balance here, it is a little bit easier to recover as someone who had to now start investing and ride through one of these kind of very kind of severe market declines. So that is kind of meant to show a little bit of just what you can expect if you are going to be trading with a smaller balance account. Start with just adding that extra money. I used to joke, used to be trading for, say, lunch money. But back when I was getting started here, oh, I can treat myself to a better lunch, maybe a dessert at lunch, and then build up from there, right? Start with a smaller, more achievable goal, and then build up from there. So in order to kind of trade, not only do we need to have the right expectations, we need to ensure that when we're trading with a smaller balance account, that we understand, well, cash and margin rules. So I'm going to jump into just some of the rules surrounding a cash account. And if anyone is wondering, well, what is a cash account? Well, that's what everyone starts with. If you have an individual account, if you have a joint account, a trust account, an IRA, Roth, a rollover, or a traditional, it's going to default as a cash account. Money you put in there is in cash, and you can buy and sell with that cash. And there are some kind of rules surrounding this. And what that is that you can buy with that cash you have. Fidelity even lets you buy with a credit. That's cash that's kind of coming into the account that you haven't even received yet. For those of you, again, that have been with Fidelity for quite a while, especially when settlement times were longer, there were times when you could call up a broker, say, hey, buy ABC stock at the market, buy 100 shares. I'm going to stop in the office and drop a check off, or again, even further back, I'm going to mail in a check to pay for the trade. Back when settlement was, say, 5 days, and it was enough time in the mail for the check to arrive. Now, you could do that. We allow you to buy on that kind of good faith, but selling those shares that you may be buying on a good faith is what could get you into trouble. So there are a few different kind of cash account violations that can occur. But of the three, and what they are called, just so you know the name, there's what's referred to as a good faith violation, a free ride violation, and then finally I guess we'll just leave it at that here. Then there's a type of third violation, but again, that's not really going to come up too often. Looks like we've updated this to remove some of the lesser common ones. Now, the good faith violation occurs when a security is purchased in your account and sold before being paid for with the settled funds in that account. And just to run through a bit of an example here, using good faith violation example 1. So let's say that you start Monday in your account with $0, no cash at all. You go ahead and sell XYZ stock in your account Monday morning, and you net $10,000 in cash. Now, later on in that same day, you buy another stock, in this case, ABC stock, for $10,000. At that point, there's been no violation. You started with no money, you sold one stock, you're getting the credit, and you bought shares of another stock with that same cash proceeds. That's perfectly fine. Notice the buy isn't an issue here. And did we update to settlement rules? Is that if you were to sell a stock prior to that day of settlement, which is almost in this case, as long as it's not that same day, you're going to be, you can avoid these rules. So it's still fairly flexible. And hopefully, I think I might have gotten a little bit kind of unstable there for a second. I'll maybe close some programs in the back so I don't skip there. But as long as you're not selling right that same day, you're going to find yourself at least having that cash to pay for it in most situations. But let's talk about maybe one more example here. Cash available to trade, 10,000, all of which is settled. So you start the day with $10,000. On Monday morning, you purchase $10,000 of the stock. That's perfectly fine. You get $10,000 all settled. You bought XYZ stock with it. At around noontime, you sell XYZ stock for $500 profit. So you made 500 bucks, right? That's kind of fantastic return already there, just in maybe a few hours in the day. So now how much cash would you have in your account? 10,500 as a credit. So at this point, no good faith violation has occurred because you had settled funds at the start of the day that you could use. So buying and selling in a cash account same day is allowed as long as you have those shares to fully satisfy. Now, of course, if you sold that ABC stock that you bought for 10, if you kind of purchase an additional, I guess I should say, 10,500 shares of ABC stock, and you ended up selling them, that would be the issue. So as you can see, if you start with cash, you can buy, sell, and buy and not be a problem. Again, as long as you're staying within that cash credit. Good faith violations are really triggered from the sale. So it's only the sale of a stock that is going, or an ETF, that is really going to get you in trouble. Now, there is a third example that doesn't come across that often. Oh, there it is. So we do still have the third, the cash liquidation. Cash liquidation doesn't come across too often. That's when you purchase securities and the cost of those is covered after the purchase date by the sale of other fully paid securities. Again, I don't want to spend time, this isn't a full restriction class, but it's something that doesn't come across too often because typically the website is going to prevent you from buying when you don't have either cash or the cash credit. So this isn't something that's going to happen too often. And then finally, the free ride violation occurs when you purchase security and then pay for those with the cost of securities by selling those very same. Again, free ride, it doesn't come across as often just because the website does it generally a good job at preventing you from finding yourself in either cash liquidations or free ride violations. So just going back to the good faith, we understand that sometimes, you may be selling quickly. That's quite all right. You might miss the notification. The good news is that you do have a certain number of good faith violations before you get restricted. And if you were to have three of them in 1 year, what ends up happening is that your account will be limited to settled fund trading only. Now, the longer that I've been a Fidelity, the better it's getting for even if you were to get a good faith violation in the past, you might have had to wait 5 days to buy again after you sold the stock, then 3 days, then two. Now, if you sell a stock, even if you're restricted, you're able to purchase the next day because settlement is only 1 day. But ideally, you don't want to have your account restricted. With cash, it's great when you can buy and sell and then use that same credit to buy another stock again without having to wait for the very next day. Now, in order to kind of help avoid these, I do want to quickly show just the balances very fast from some screenshots of an account here. And again, this is for folks that are only trading in a cash account. So in this example, imagine an account with only $2,000 in it. And at the start of the day, we had $33 in cash. Now, would that right now, that's where we're kind of starting. And let's say in this scenario, we ended up selling a stock because we have of the $2,500, 33 is in cash, and the rest is in one stock. So let's say we sold, in this case, it's Qualcomm here, QCOM, and we took in 1,800. That $1,800 now is able to be used in addition, 1834 is able to use in addition to the 33. So we have 1867. And pay attention to these two differences in the balances section. You have available to trade and then settled cash used to purchase securities that can be sold at any time. Available to trade means you could spend that whole amount today, buy with it, but you're not able to sell it until settlement, which would be in this case on Monday. The settled cash is something that you could buy and sell with the very same day. Now, the good news is that we do give you a bit of a warning if you were going to purchase a stock here. And in an example, let's say we were going to buy, and I just tried to pick something with lower priced, Ford Motor, so symbol F. At the time I made these screenshots on March 4th, it was about $13. So let's say we were to buy 2 shares at the market at about 13, it would cost roughly $26. And that's perfectly fine, right? Buying isn't an issue. If the website lets you buy, generally you're going to be all right just to purchase. We could, because it's under the initial 33. Now, what if we were going to buy more than $33? So instead of 2 shares, what if we bought 20 shares of Ford? $260 is our total cost, which is above that 33. Can we buy? Absolutely. We can still buy because remember, buying doesn't cause the violation. It's typically the selling that's going to cause the trouble. And we'll give you this warning, right? The buy order you're about to place exceeds your settled cash balance. So selling these shares before paying in full for the trade could result in a good faith violation. So as you can see the difference, I'll go back and forth. 2 shares within our settled cash, 20 shares over our settled cash. We can still buy, but we give you the warning that if you are spending more than what you have in settled cash and you were to sell it, that will cause a violation. So, Don, I see your comment here. What I don't understand is why Fidelity warns you at the purchase. of a potential violation. But when you sell that position, there's no warning. It would avoid a lot of violations. So it should be giving you a warning when you sell it. I would agree there. If anyone is missing it, it probably needs to be maybe another kind of check mark to say, hey, if you sell this, it's going to cause a violation, because that can recall numerous times where clients have ran into that scenario. I've also seen some folks say, hey, why does Fidelity let me sell it if it's going to cause a violation? And then that's still a good thing, right? It's better to get a violation strike on your account, which eventually is going to drop off at some point in the future, and get out of position, especially if you either want to take that profit or save yourself from a loss that could be snowballing to the downside. So these violations, they're kind of strikes on the account that are going on any credit report or record. So don't worry about that. They're just, once they kind of, after a certain amount of time, they do drop off. And once you have a restriction, if you found yourself in a restriction, it'll be for 90 days. And at the end of those 90 days, it gets cleared and everything is in good standing yet again. So I see a question: how many days you have to wait once you sell a stock? The cash seems to stay yellowed out for 2 days. So as I kind of mentioned a few times here in the past, when you sell a stock, if you're waiting for the settled cash, you would have needed to have waited 2 trading dates, 2 kind of settlement days. But nowadays it is one. So fortunately, if you sell something, you should have that credit in your account kind of the very next market day. Now, not all market days are settlement days. I think there's only one. I think Good Friday might be the only day where there's no settlement day, but the market is open. But generally, trading days are what you're going to be using to count it. So again, just one other question here, and we can jump over to some of the margin side. So in a cash account, if you start with settled cash, you can buy, sell, and buy. That's correct. The buy, sell is going to be the issue. Remember, it's that sell that's the problem. So again, looking at that example here, we could buy with $33 or less and sell and buy again, but then we can't sell, because at that point, let's use this example. Let's say we did spend something for $33 and then we sold it. We would have no settled cash. All of that would be available to trade, so we could buy again, but we wouldn't be able to sell it. So hopefully that helps, again, at least understand some of the rules, because if you don't follow the rules and the balances, well, it doesn't matter how good your trading strategy is, because you'll be restricted and it's going to slow you down. Now, it is still helpful to understand, to some extent, kind of margin. And we're not talking about margin in the case of margin debt, margin loans, borrowing, but margin trading to allow you to kind of take advantage of I don't want to say the no settlement, but the ability to kind of trade around those settlement timeframes. So, Chase, were there any other question that you wanted to cover here? If not, we can jump into to margin.
Yeah, one thing I want to point out real quickly here, James, you mentioned the word or the term cash account a variety of times, and I saw a couple comments about an IRA. As a general rule of thumb, if you have an IRA, excuse me, whether it's a Roth IRA, traditional IRA, a rollover IRA, those are going to be cash accounts. It's a retirement account. You can only trade with your cash. Uh, you're not able, or we don't provide the feature for you to have true margin on the account. Now, if there's time, we can go into something called limited margin, but that's kind of a different use case with an IRA. But just generally speaking, if you have a Roth IRA, a traditional IRA, you're thinking, is this a margin account? Is it eligible? Is it cash? It's going to be a cash account. Okay. Just so everyone understands, like I know people trade both in an IRA and maybe a non-IRA, or sometimes we refer to those as taxable accounts. And then Anonymous saying Fidelity offers limited margin. Yeah, once we cover margin itself, then we can get to the limited margin aspect, maybe talk a little bit about the differences and the benefits there. James, let me go ahead and update the screen share for just a moment here to my Google Chrome here. And there is something I want to share. I know that you mentioned it sort of in passing, but just to make it clear for clients, especially who've been trading for these past couple of years, I want to share a page from a third party. In this case, it's FINRA, right? This is one of the regulatory bodies that oversees Fidelity and licensed brokers and advisors here in the industry. So obviously very reputable, but they're a third party from Fidelity, right? Not affiliated directly with us. And there's an article here which you can just Google search that talks about this change in settlement. But I just want to make it clear for everybody. It used to be a 2 or even a 3-day settlement, but it has now changed to 1 day, as James had mentioned. Now, what does this apply, or what does this maybe affect? So these new settlement timeframe structures, which are now already in effect, are for stocks, bonds, municipal securities, ETFs, and then certain mutual funds and limited partnerships that trade on exchanges. So if you're very, very used to the T+2, or if you sell something, those funds aren't really technically settled until 2 days after. James mentioned it. I just want to call attention to it. This has now become the industry standard, finally, of 1 day settlement. So it's much, much quicker here. And that's worth noting, because as we're talking about these rules, traders used to look to margin, which I'll get to in a moment, as like a really strong value proposition of a feature to add, because they didn't want to wait 2 or 3 days for funds to clear. I would just point out, though, with some of these new rule changes, maybe that value proposition is coming a little bit more into question. So we'll talk about it here. Okay, James, I'm on the FAQ page here on fidelity.com for margin. You can just search for this on the website. You'll find it right there. So what exactly is margin? I do want to break it down a little bit so that we can make it clear about the difference, or when or if you're going to use a loan versus maybe trying to circumvent or skirt these different trading rules that James was just mentioning in a cash account. So how does margin work? We give you all these examples with some numbers, and we're happy to run through them if we need to. But the way I think about margin is you're able to take, if you choose, your same cash and trade with it more frequently, or in addition to, you can take a loan from Fidelity in excess of your cash and borrow. Now, those are sort of linked, but they are separate categories. There are people who can trade in a margin account and never borrow a penny from Fidelity. In fact, there's many clients I've spoken to who they take great pride in that. They said, hey, I've been trading at Fidelity for a decade. I use margin so that I can trade in and out without really having to worry about settlement, but I never pay a dime, right? Not a single penny in interest. There are other traders, however, who use the other additional benefits or characteristics of margin that allow us, Fidelity, to provide you a loan within your account, and you can then use that money to buy something, more things than just your cash would allow. Now, there's some pros and cons to that, right? Just like if you take a loan out for anything in life, there's risk, and the stock market can be very volatile. So with this example, we talk about more of like the borrowing aspect of it. So I'll just cover that real quickly here. So if you have an account, let's say that has $5,000 of cash, for sake of argument, let's call it settled cash. You have the money in the account. Then Fidelity can provide you a loan, let's say of $5,000 of additional proceeds, if you will, into your account. So now you can buy $10,000 worth of stock. Okay. So of the $10,000 of an asset, in this case, stocks, 50% is your money, your cash, and then 50% is ours, right? Now, if the stock rises to, let's say, $11,000, so it's increased in $1,000 of total value, right? 11,000 minus 10,000 is $1,000 in unrealized profit, and you sell it. What does that really do? What happens next? Well, like any loan, you're going to pay us back. You're going to pay Fidelity the $5,000 principal that we provided to you, plus any interest if necessary. But you get to keep the difference of this. So you spent 10,000, but you owe us 5. This thing's worth 11. So really, you get to realize that $1,000 profit, less any kind of fees or interest that you have to pay to us, and you pay back the principal. Now, here's the kicker, James, and this is why people used to be really attracted to the borrowing aspect of margin. It's leverage, right? We always use that term here in the financial landscape. That's a 20% return on investment. Well, what do we mean by that? Well, the extra 5,000 isn't your money, it's Fidelity's, right? You only tied up $5,000 of your own cash. So if you make $1,000 rate of return or $1,000 net profit off of 5,000, that's where we're getting that 20% return number from. Okay. So you might say, well, Chase, that sounds fantastic. Who doesn't love free money that comes out of thin air that lets me buy more stock? And when the stock goes up, I make more money than I would have. Like, what's the problem? Well, the issue is what if the stock goes down, right? So that probably is a bit self-explanatory, but if you buy again at $10,000 worth of stock, but the stock goes down in value, you still owe us the principal back and interest. And that's where things start to get really dicey here as we look into these further examples. It goes on to say if you buy $10,000 of stock, it drops down to 9,000. The equity or your ownership in the account would fall to $4,000 because you still owe us the 5, but now you've got less money in there. So that's a 20% loss with only a 10% decrease in market value. So there's leverage here, right? There's a lot of different examples. There's a lot of math behind this, James. We could spend all day going through different calculations of like, how do you calculate how much you can borrow? I don't know that this is necessarily the right session for that, but I just want to point out that you can borrow with margin. However, I say all that to say this, you don't have to borrow, even if you're trading within a margin account. Okay. So I want to just, I'll skip some of this for now. We can come back to it if necessary. But what does that really look like? We're going to go over to the accounts and then the portfolio page here on Fidelity Investments. And then we're going to skip over to the balances tab. Now, keep in mind, folks, this is just a test account that we use. So some of these numbers, you know, they just are what they are. So there's a bunch of random stocks and positions in here. And what we're going to see is a very different landscape of balances relative to what James was just showing us in a cash account. By a raise of hands, who has just a normal account? Cash account, an IRA, right? Just maybe a non-taxable trading account. We refer those as an IRA, right? If you look at your balances, you're not going to see these. These won't appear, most likely, unless you have some other features enabled. But even then, they're still going to be different. So this indicates to us, if we see margin buying power, that we have a margin account. But here's the difference. This balance right here, available without margin impact. This balance, even though this is a margin account, indicates to us how much we could trade or purchase, let's say, within this account and not take out a margin loan. So even though you're trading in a margin account, this isn't leverage. You're not borrowing from Fidelity if you stay at or underneath this balance. I know it's kind of confusing for a lot of clients. Like, wait, isn't it a margin account? Then you just say I could borrow. Yeah, you can borrow once you exceed the actual cash or value that you have available to trade. Past that limit, we could then provide you a loan if you wanted to. You're not required to. So if all of your life, when you trade within a margin account, you stay at or beneath this balance, you won't pay interest. You won't take a loan. Okay, good to know. So why do I bring this up? Because when you're buying and selling within a margin account, you can think about it almost as two different accounting ledgers. You have the cash side and you have the margin side. Well, essentially, as you sell something, you get a margin credit, not a cash credit, a margin credit. Because when you purchase the stock, you purchased it on the margin accounting side of the account. You can think about it as just, you know, accounting 101, you have these different ledgers, right? So when you sell a stock that was held on the margin account, you receive a margin credit, not a cash credit. And so then you can then go and use that margin credit to place another trade if you'd like to. And this is how we kind of get into that circumvention of the more typical cash settlement rules. Because if you have a cash credit, then you have to be mindful of those violations that James talked about. But a margin credit is different than a cash credit. It doesn't follow those cash settlement rules. So there are traders who will stay underneath this balance and they'll just do their best to buy and sell within reason here to take the benefits of margin, not have to worry about waiting for things to settle, but then also not actually borrow from Fidelity. Now, if you wanted to borrow from Fidelity, you could go ahead and exceed this number, and this margin buying power balance then goes on to explain how much of a fully marginable security that you could buy in this account, including taking a loan from Fidelity. Now, there's a lot to even unpack in that statement. Like, well, what is marginable, right? What securities are eligible maybe for collateral, and what can we use in terms of margin? So, not everything you're able to do this with. So, equities or stocks, ETFs, some mutual funds, some other securities as well here. However, options aren't marginable. James, I know you briefly mentioned options as well here. When we look at this balance, if someone said, hey, Chase, could I buy $16,000 of options contracts in this account? The answer is no, because options aren't a fully marginable security. Okay. You have to pay for them in full. You can't use something that has those different requirements. So you really be looking at a balance, something like this, for example. So depending on what you're trying to buy, these balances will apply differently. Now, if I take just a quick step back, I mentioned that if you sell something after buying it in margin, you get a margin credit. And hey, that's wonderful because now you can take that credit and you could buy and then sell, buy and sell. But are there some considerations that maybe we should be mindful of? Yes, there's something called a pattern day trader. Has anyone heard this term before? Just by a raise of hand or leave us a comment in the Q&A. A pattern day trader, or maybe just a day trader if you've heard that term being used as well. So there's a couple of very specific regulations and rules that dictate if someone meets the definition of a pattern day trader. There's a classification that you have to meet essentially. Now, one of the things that we try to clarify, Miroslav is saying guilty as charged, right? Yeah. So one of the things about being a pattern day trader is there's only so many day trades that you can place within a period of time before you get kind of that label slapped on you. And then you have some basic requirements that you have to meet. Now, Fidelity will do our best to communicate this to you, to say like, hey, once we get there, like, am I a pattern day trader? Am I not, for example? But one of the ways that we think about it, excuse me, is if you're placing 4 more day trades within a rolling 5 business days, that's the way the regulation used to be defined as, then you may be classified as a pattern day trader. And you say, well, hold on, what's a day trade? Well, let's take a step back. A day trade would be if you buy and sell a security, the same business day. Now, the trick question might be, well, Chase, if I buy something in the pre-market, so extended hours before the market opens, I don't sell it during the standard session. I kind of hold throughout the day, and I sell in the after hours in extended markets. Does that still count? It does, because it's the same business day, not session, business day. So if you bought it on a Monday and you sold it on Monday, that's considered one day trade. Okay. Well, could you place 4 day trades in a single one day? Yeah, you absolutely could. Or you could place a day trade on Monday, then another one on Tuesday, another one on Wednesday, Thursday. We're at 4 day trades within a 5 rolling business day period. We may then be classified as a pattern day trader. Now, what's like the real big worry about that? Like, why does anybody care? Well, you're going to want a margin account at that point because it's going to be a margin classification. And when we think about this here, there's a balance requirement that comes with this, or an equity requirement, if you will. The threshold that was set by our regulators is $25,000. So, James, that's why we brought this up today, isn't it? Because if you have a small balance account and let's say you're approved for margin, but you're doing a lot of day trades, what if you don't have $25,000 in your account? What if you're at 10,000? Well, if you place all these day trades and then you get classified as a pattern day trader without being able to meet those basic requirements, then the account can get restricted. And nobody likes that. So that's why we're covering here today. That's why we're trying to warn you about the benefits of margin and how you can use it without leverage or without borrowing, although certainly you could as well. Why someone would use that to circumvent some of the cash settlement requirements, but then also warn you about, well, if you do that, just keep in mind how often or how frequently you're doing that so that you don't maybe get hemmed up with these classifications. One thing I'll point out real quickly here, James, and I'll pass it back to you just to see if there's any other thoughts you want to add when it comes to margin and whatnot. If you're ever trying to be or try to clear any ambiguity that is occurring within your account when it comes to these restrictions or classifications, under balances, there's a trading profile section and it says restrictions. If you actually click on this, I'll update my screen share here. You'll get a separate pop-up window that will appear. So this will show here. It says you have no trade restrictions on this account. I hope so. We don't really do anything in it. It's a test account, right? But, excuse me, it will say day trade designation, non-pattern. So right now, this is not a pattern day trader because we haven't met those classifications yet. But we will provide you a day trade counter and any other unmet day trade calls, which would be essentially if your account is below that $25,000 equity threshold. Also, what other kind of liquidations do you have, if any? Are there any violations in the account? And James had mentioned those free rides or good faiths. We're going to track those to the best of our ability. I'll admit it's a system. So are there times where maybe it should have tracked something and maybe it didn't, or it didn't track something when it should have, potentially? But we do our very best to try to keep that as clearly disclosed as possible. You can check this every business day. James, I'll take a pause right there. Anything that you want to clarify on what I've covered up to this point about what margin is, the delineation between leveraging margin, like borrowing, versus just trading it within a margin account for credit and margin settlement, if you will. And then also some of these considerations of like a pattern day trader and some of those trade restrictions.
Well, this is a question I want to make sure we clarify it. So we'll be mentioning if I execute only three trades during the week, 3-day trades, I imagine, with less than 25,000, you won't be considered a pattern day trader. So keep in mind that when we're talking about, you can do any number of trades. It's really about day trades, and that only applies if you're trading in margin. If you're trading in cash, as long as you've got the settled cash, you can do as many day trades as possible, right? As long as you've got the settled cash to do it, you're not going to be considered a pattern day trader. The pattern day trader, that's only for margin. So if you are trading in margin, which can be anyone really over $2,000, it's typically the minimum, even though it's really only for borrowing, but we still want folks to have 2,000 at least to have margin. You can day trade. Again, as long as you're following the rules of not going over kind of your intraday, not as long as you're still following the margin rules, you can day trade 3 times and you're fine. But once you hit that 4th day trade in that week, not just the calendar week, but in that rolling kind of 5 days, that's when you're going to find yourself in trouble. Typically, what I would suggest for folks is if you have a margin account under $25,000, I just stick with cash. Nowadays, with the 1-day settlement, as Chase mentioned, it somewhat got the allure out of the way. If you're over 25 and have some room there, right, not 26,000, because then you have a bad trade, you're going to fall under. Then you can think about adding margin for the purposes of day trading. So hopefully that helps. And the question was, I thought real day traders made multiple trades a day. That's correct. I mean, if you have a pattern day trading account, you're using margin, you can do an unlimited amount of day trades per day as long as you're sticking with that intraday buying power. But I want to, for the final kind of 10 minutes here, I want to talk about one other idea. Since now we do have the options and designation on this, and that is to talk a little bit about how maybe options can be used for a smaller balance accounts should you decide to wade your waters into it. Now, of course, options trading entails significant risks. It's not going to be appropriate for everyone, but there are some kind of ways that you can use the leveraging ability that's different from leveraging ability of margin. And I want to take a symbol from someone in the audience here, as long as it has options on it. But I'll try to take the first one that comes through. If anyone wants to send a symbol, I just like to see what everyone is looking at from time to time. We can use that to show an example between buying shares of the stock and using an option. I have Apple here, but let's see. Okay, we got, oh, wow, all came in at the first moment. Christine, I saw yours come in first here, Tesla. So TSLA. We're not going to do a deep dive on the underlying, but I just wanted to use it for an example. So here is our Tesla chart. And let's say we thought Tesla was going to go to $200 per share. And let's talk about the difference between kind of buying shares versus buying an option. So about 15% more or less from where we're currently trading. I'm going to use my profit loss calculator. This is an options tool for those of you that haven't seen this before. And we're going to compare two scenarios. Let's say we're interested in kind of purchasing some Tesla shares. We've only got, say, I want to at least make it so we can buy 100 shares. So let's say we've only have $20,000 in our account. We're going to add a simulated position. We don't need to spend it all. We're going to buy 100 shares of Tesla. And I'm just trying to make a more or less a round number. Yeah, 175.20. We'll click apply. So this allows us to model what happens if Tesla goes up or down. Right? If Tesla goes from 175 to 190, how much money I'm sorry, from 175 to say 200, right? How much money are we going to be making? And we'll be able to see that populate kind of down below here. Now, if we were to add a simulated position, this kind of factors in what it would look like if we were to purchase an option. And we should be getting a chart here. Let me pull up a brand new one. Let's see if we can get this to, got the little caution sign down here. And this happens with all of our team using the same account. But let's see if we can get it to populate here. We're going to buy 100 shares at 175.20. Let's click apply. Well, let's see if it works for the option. Fortunately, when it comes to the stock, we can calculate that easily. So a $20,000 account, we're spending $17,500 on Tesla. But what if we wanted to use options? I'm going to pick an expiration just kind of randomly here. It really doesn't matter too much. Just go to October. And what some traders use, and there were some I think well-known politicians that trade that did this type of strategy, and that's purchasing what are called in the money options. I'm going to go very deep in the money in this case. Well, 100 strike, purchase a call, and it's going to cost us, just to get somewhere close to the midpoint here, and I like my round numbers, $79. And looks like it doesn't want to work for me with Tesla here. Let me see if I can get another symbol that came through. Who gave us, I think Mara. Someone gave us Mara here. Let's see if we can get a graph for Mara. I might have to restart this. So Chase, maybe if you are up for answering a question, I'll restart my active trader because I still want to show this. Let's see if it works for us. Yeah, I'll have to restart my active trader. So Chase,
Yeah.
I don't know if there were any questions we can answer real quick. Just give me maybe a minute to restart active trader.
Yeah, no worries whatsoever. There was a few things I wanted to address anyway, so that works out perfectly fine, James. So let me hop over to my ATP for just a moment. One of the questions that we got that came through was, well, are we able to like choose if we're in margin or cash? If we, let's say, have a margin account, but we did want to trade on the cash side or under the cash rules, if you will. And you absolutely can. On ATP, for example, up in the settings, under the trade dropdown, there is something that says always display trade type dropdown, cash margin for margin accounts. In other words, once you're approved for margin, do you want to have the ability to then choose between being under those cash and or margin rules? I typically have yes on these accounts, just so that if I ever want to make that decision, it's there. So let's say you wanted to buy 10 shares of Apple, right? And it's a small account. You're thinking you want to day trade it, but you don't want to fall under the day trade rules of margins. You want to trade it under the cash rules in your margin account. I know that's a bit of a tongue twister, right? But I promise you with time that will make more sense. You can then change this type from margin to cash. So even though the account is approved for margin, the trade will be under the cash kind of ledger, if you will. Again, the best way I can explain is think about your account having almost two different accounting systems, and you're kind of choosing, if you will, which side of it falls within. Another question that we got here, James, was this comes from anonymous, but they're saying, if I open up an account, do I automatically have margin? Like, do I have to switch between it? How do I turn it off if I wanted to? So let me just clarify that point, which is a great point as well. We'll go back to fidelity.com. So when you open an account, by default, it will be a cash account. You actually have to apply for margin. Now, in more recent years, we've made that easier to do, but you still have to do it. It's not going to be done automatically. If you ever want to check this, you can go on fidelity.com and you can go to your profile up here in the top. And within profile, there's all kinds of account features and everything else. If you actually take a look through here, there's all kinds of beneficiaries, account registration. You can go through and make some adjustments to this if you'd like to, some of the communication preferences. But if we go over to accounts and trade, then account features specifically, this will then link us to, again, you can use one of those links to get here. This is another way to do it. It brings you over to the brokerage and trading section, and then there's margin. So if you want to add it, you can click this and then you can choose for each individual account that you want to apply for margin. If you have, let's say, 5 or 6 different taxable accounts, you don't have to have margin on all of them. You actually get to choose, which one that you want to apply for. And then just very lastly here, James, I know we're coming up to time, but I did want to point out, if you do have a retirement account, so an IRA, a limited and rollover IRA, traditional Roth, whatever it might be, you can apply for a feature called limited margin. The IRA has to be of a balance or equity, again, in excess of $25,000 or greater. The idea here is that with an IRA account, we can't extend you a loan. We can't let you borrow. So it's not full margin. It's limited because it allows you to trade and day trade in and out like a margin account would. But there's just no ability for us to extend to you a loan. So it's kind of like margin in that you can use those margin credits when you're buying and selling, and doing some day trading and not have to worry about cash settlement. But it's limited in that we can't extend you a loan within the account. So if you have a balance of greater than $25,000 in your IRA and you want to day trade and you're understanding some of those day trader rules, then you may also apply for limited margin. Again, if you have any more questions about it, I know we're coming to time. Obviously, you can just type in limited margin or margin. We've always got more information on the website. James, were you able to get that example pulled back up?
Yeah, I was able to. I know we won't be able to go too much into it, but at least I think the point will be made. So if you can recall, we had an example with Tesla here. You could spend $17,500 for 100 shares, or you could buy what's referred to as an in-the-money call. How far in the money? Well, generally, most folks are looking for a high delta. Not that you need to know what that is, but this is more just to show the general idea. And if you're interested, join us for some of our options sessions. But in this example, again, what if we thought Tesla was going to go to $200 per share at some point? Doesn't matter when. Maybe it takes a few weeks. What would our profit and loss look like? So here, as you can see, we've got our stock and our option. Now it's very simple, right? Tesla's up $25 a share. We bought 100 share. We're up $2,500, right? Perfect there, right? It's easy when it comes to the stock. But look at our option. It moved almost the same. Instead of 2,500, it's 2,356. So sure, we put in less money, but so we're making less money, but we put in significantly less. We still have the exposure of 100 shares. So let's see in this example, right, where $2,500 over 17,500 is about 14%. Remember, we talked about that's about 15% gain. But 2356 on $7,900 is, well, about 30%. So that same 15% move in Tesla gave us $2,500, but with our option, sure, we're making roughly the same, but for a percent of our capital, it's significantly more for the option. So this is why folks with smaller balances like to use options, because you have that leveraging effect. And remember, in this case, we only had 20,000 in cash in our account, so we still have the other cash sitting on the sidelines. But we always want to talk about not just profits, but also risk. What happens if it goes down? All right, let's take a look. What if Tesla goes to 150? All right, we're making 2,500. We're losing 2,500, of course. We're losing close to 2,500. Now, understand that, yes, from a percentage point, we are losing more as a percentage of our capital. But when looking at our overall risk, right, a $20,000 account, we're still losing the same amount of money, right? Tesla goes to 125. We're losing again roughly the same amount, even less. Tesla goes all the way down to 100, right? We're losing the call, we're losing less. Tesla goes from, okay, so we talked about it from the risk perspective. Tesla's going down. We're still losing the same amount. If Tesla goes up, I'm going to go an extreme example, 225, right? We're still making the same amount. So using options, you can still make or lose, right? Very similar amounts as long as you're not leveraging, but your risk is still limited because you only have, in this case, $8,000 put in. And this is why some traders, I brought up a well-known politician that's trading, choose in the money options because it eliminates much of the options centric characteristics, such as the sensitivity to time and volatility. You gain far more exposure to the underlying, but if that's your goal, well, then these can work. Now, all because you can doesn't mean that you should. Sure, you could say, well, I could buy 2 contracts. Well, now you're using leverage. Right now, you're spending almost the same amount of money. If Tesla goes up to say what we thought, 200, right now you're making twice as much. If Tesla goes down to say 150, right, you're losing twice as much. So if you're going to be using options, if you've got a smaller balance account, don't necessarily take on the leveraging ability of them, but think of the case of, hey, I can still gain the same exposure, but I'm freeing up other capital for other purposes. Maybe, now you say you want to purchase 100 shares of Tesla, that's almost all of your capital. You could buy one call, buy a call of another stock, buy a call of another stock. And as long as you're not getting yourself over leveraged, you might be able to take advantage of that leveraging ability that options have. So again, it's not an options class. We didn't want to go too far into it, but hopefully something to think about. So hopefully that helps here. I know we're already kind of a few minutes over. I would have to spend probably another 10 minutes on these questions, but we tried to get the majority of them. Maybe I'm going to knock one more just because this was the most common one. I see a few. Just does the pattern day trader designation go away? For this, it's something where in the past it did go away after 90 days of no day trades. I want to say there was a change about a year or two ago that might have impacted this, where you might need to call in after that period of time. This is where, when it comes to just the maintenance on the account, someone from our service team is going to be best able to answer that. But again, it used to be automatic. Nowadays, I think it might require a phone call after that period of time.
Yeah,
But Chase,
James,
I'll
I'm
give you the
looking at
final
our
words here since we're already a few minutes over.
sounds good. Yeah, I just wanted to add to what you're saying. I saw that question. I was like, it's been a little while. So I'm in our internal resources here that our associates have access to. And the policy I see was updated as of May of 2023. And it does say here the classification does not drop off systematically. And previously, the classification remained for 60 days. I think the old rule was 60 days. If you didn't place a day trade within that time frame, it would fall off. But like James was saying, that does not seem to be the case anymore. So once you're classified, it would seem you probably have to take some action. Again, James and I don't do a ton of account service, but that would seem to be the case based upon the way that the policy reads. So if that happens, if you got a question, like always, you can call Fidelity. You know, we're here to help anytime, no problems. As we wrap up here, James, just a few final thoughts for our clients, and we'll let everyone go and enjoy their lunch if they haven't already. Is if I go back to fidelity.com for just one more thing here, if anyone has questions on what we talked about, which that would make sense to me. There's a lot going on between margin and cash. I would encourage you to find some pages like this. Just go to that search box and type margin or margin FAQs. You're going to find all kinds of resources like this page with the different drop-down arrows. In addition, I do want to just clarify, I kind of misspoke with the navigation. That's on me. I take full ownership. We're always updating the website. So you used to be able, at least I recall, going to profile to check for margin, but that's not there anymore. I kind of noticed that when I was going through it. You do have to go to just accounts and trade and then account features, and that will bring you to this page. So I apologize. I want to make sure everyone's got the correct navigation. Again, accounts and trade, account features, then you can go ahead and check margin if you want to apply for it. I saw a question, James, about like, well, what are we going to ask you? It's pretty transparent, simple stuff like what's your trading experience? I think what's your risk tolerance? You know, how much money do you have? Super simple stuff. At any point in time, if you feel like you're not comfortable answering it, I mean, we're not going to hold you hostage. You could always back out of the application. It's not done until it's done type of thing. So no problem whatsoever. But yeah, leverage the online learning center. Just search the word margin. You're going to find all kinds of helpful information. If we weren't associates at Fidelity and we haven't been doing this for years, I get how complicated this is. You know, the first time we learned about it, there's a lot to take in. So lean on us, leverage us, look at those tools. And as we have more sessions like this, follow up with your questions. James, pleasure to see you here this afternoon. I know it's Friday, so we're all getting ready for the weekend ahead. The weather's nice here in New Hampshire today, so we're definitely blessed. Thank you, everybody, for spending some time here with us, and we'll see you in the next session. Till then, take care.